Good morning and welcome to Manning Fulton's flash briefing on estate planning strategies post-election and year-end. We're going to jump right into it. Steve Bird's going to start us off. Steve's a partner at Manning Fulton and practices in a diverse range of business transaction matters, tax planning, estate planning, and wealth transfer matters. He's a North Carolina certified specialist in estate planning and probate law for over 25 years, former chair of the North Carolina Bar Association tax section, and has retained his CPA license for 20 years before retiring it recently. He's been recognized by the best lawyers in America in the practice areas of tax law, trust and estates, mergers and acquisitions, corporate law, business organizations, and has been recognized by the Business North Carolina Legal Elite in tax and estate planning. Steve, start us off, please.
Good morning, and welcome again, everybody. I'm glad to see you all made it out in this horrible weather and across town to go to this meeting. We feel very privileged that you're joining us this morning. Also pleased to see several of my clients on the phone this morning. I guess the trick will be whether you hear the same story twice. In many respects, that's exactly why we are here, because the story keeps changing, right? In an amazing, incredible, challenging, difficult, unprecedented business and health environment and political environment in this country. We are now 9 days after election night with tremendous uncertainty relative to the question of divided government. If you claw back in your head to your civics classes in high school, you'll remember we kind of have a federalist society. We have a system of checks and balances, and we could be headed for a dividing government in very close election. President-elect Biden appears to be headed to the White House. He is the presumptive president-elect. The House has retained a very slender, in relative terms, majority of Democrats versus Republicans. This morning's count, it appears there are 218 Democratic representatives, 202 Republican representatives, 15 seats left undecided in a 435 seat House. So with 218, the Democrats currently have 1 seat majority. That's predicted to grow, but Republicans are leading in many of the remaining seats. And Wall Street Journal reports this morning that we haven't had a Democratic majority of this slim a number since the 1940s. So it will be very important for the House Speaker, Majority Speaker, whoever that is. Right now it's Nancy Pelosi, to try to keep that majority in line. Most importantly, in the Senate, as of yesterday, CNN is actually, it may have been Wednesday, CNN predicted the state of Alaska would go to the Republican Senate, and that gives the Republicans 50 senators. Democrats have 46 that have been declared as winners, and there are 2 independents that most commonly vote with the Democrats. So at this point, there are 58 Republicans and 48 folks voting with the Democratic Senate majority. So that leads us to Georgia. As many of you know, Georgia is headed for runoff elections on January 5th. So we're not quite 60 days out, but 60 days out from 2 runoff elections that will be critical. If the Democrats take those 2 seats, we'll be in a 50-50 deadlock, and the vice president will decide major tax legislation and major health care legislation, presumably. So it is critically important for a divided government. If that's what stands in the way with dramatic tax change, that'll be critically important, and that's where we could be headed to avoid dramatic tax change. The Biden tax plan, I've seen estimates, is projected to raise between $2 trillion and $3.8 trillion over the next decade. That is a dramatic impact on our economy, folks. And it is a dramatic effect on business and policy as well. So the Senate is going to be critical to somewhat maintaining the status quo. What is the status quo? When I first started practicing law, for the first half of my career, it was largely accepted in the tax community and the financial community that dramatic tax change was something of relative infrequency. There was a perception that it was good for business to have that stability of long-term planning. Really, since about the year 2000, that has narrowed amazingly and increasingly. And with almost chagrin, I used to tell my clients after practicing for the first half of my career, there was a certain sadness, there was a certain frustration about telling them that many planning windows are narrowed. You have to be very nimble on your feet to plan business relative to tax policy in this country, and increasingly so. Just an example, where are we in the estate tax exemptions, the gift tax exemptions? Well, again, when I first started practicing law, we were in an environment where the estate tax exemption, which is the most value you can leave your heirs effectively without estate taxes, it was at $600,000 per spouse. That meant if you were married, you could leave $1.2 million to your heirs without estate taxes. After that $1.2 million, when I first started practicing law, the estate tax rate was 55% on the wealth over that number. 55%. The estate taxes in its 100-year history have been as high as 77% and then 70%. So it is not unlikely that estate tax rates could change. In fact, the Biden tax plan would increase the tax rates from 40% to 45%. So what happened with the exemptions? Well, around the year 2000, we were in an environment in the context of 10-year budget resolutions. Congress self-imposed rules that if you raised exemptions and other tax losers, they had to be offset by an equal amount of spending reductions. Otherwise, you could not have permanent tax legislation. You had to have tax legislation within the context of a 10-year budget resolution, where the budget effectively balanced between reductions in federal revenue and increases in spending. So we had a 10-year law in the year 2000, 10-year budget-based law, where exemptions were raised from $1 million during that time. It was actually going from about $650 to $675 to $1 million, and then up to $2.5 million in the year 2009, and then 1 year of repeal. In 2010, we had a state tax repeal. George Steinbrenner died in 2010 and passed his multi-$100 million estate free and clear of estate taxes. By 2011, we had a just a two-year legislation to increase exemptions from 1 million, which was the permanent estate tax law at the time. It was going to roll back in 2011 to $1 million. We got a 2-year Band-Aid, if you will, to have a $5 million exemption. When that exemption was about to run out in the last week of December 2012, and we were going to roll back from a $5 million estate and gift exemption to a $1 million permanent exemption, the last week of December, President Obama signed new tax legislation that was a fairyland, in fact, of extravagant wealth transfer planning relative to what we'd ever seen, and that made the $5 million exemption permanent. It was indexed for inflation, and then 18 months later, in his proposed tax legislation Green Book, it's called the Green Book of the administration's tax legislation proposal in the future, he rolled it back to $3.5 million again, which actually was the 2009 number. I misstated that earlier. Hillary Clinton ran on $3.5 million. Joe Biden has run on $3.5 million estate tax exemption, but only a $1 million gift exemption. Now, why is that important? It's important because you can give away your tax-free exemption during your lifetime, or what you don't give away, you can die with it and use it to shelter wealth transfer at death. So if you give it away during your lifetime, you're going to give it away, and all that appreciation and what you give away is going to be outside of your estate. So we have been in an environment in 2018 where the Trump Tax Act doubled the exemption amount, doubled it from 5 to 10, indexed for inflation. This year's exemption was 11.58 million. The permanent law exemption underlying a 7-year budget resolution legislation in the Trump Tax Act, the permanent law exemption is half that. Trump's exemption expires in 2025 and automatically reverts to half that. So this year, half that number is 5.79 million. That's what would happen in 2025 in the current Trump Act if it's not changed, is you can give away twice that, 11.58 million this year, and in 2026, you won't be able to give away half that. So there's a rush, understandably, with Biden's proposal to have the estate tax exemption fall to 3.5 and the gift tax exemption fall to $1 million. There's a rush of high net worth people transferring wealth in various ways. Sandy and Andy are going to talk about some of the keys to that. So I would like to remind this audience, it's certainly on our website, of my esteemed partner Sandy Clark's accomplishments. She is a member of the prestigious American College of Trust and Estate Council. It really is the highest recognition you can get in the practice of law for success and excellence in the practice of estate planning law. She heads our estate planning and administration department and practices in a diverse range of not only estate planning, tax planning, and administration, including wealth transfer, but also business transactional matters, including franchise law. She's also a North Carolina board certified specialist in estate planning and probate law, and a licensed CPA, and a former chair of the NC Bar Association's estate planning section. She's recognized in Best Lawyers in America and in North Carolina Super Lawyers. Sandy, we look forward to hearing what you have to tell us this morning. Thank you.
Okay, thank you, Steve. So what do we do now? We know there potentially could be changes. We know presumably Biden will be president. We don't know for sure who have majority in Senate. It seems to be swinging a little bit towards the Republicans, but it's going to depend on the Georgia runoffs. So what do we do now? We've got a month and a half left in the year. We're assuming if tax law was to change in 2021, it would possibly be retroactive to either the date legislation was introduced into Congress or January 1st. So we know we have at least a month and a half where we're under these tax laws that we currently have. So is there a need to make changes now? So in certain circumstances, that probably is yes. So some things to consider. Of course, Biden has said he preferred to, his plan would be to lower the exemption amount to historic levels, which is assumed to be the $3.5 million for estates and $1 million for gifting. He also says he wants to raise the rates. No one's going to try to die early to get those lower rates, but you can make some gifts possibly in 2020 before year end that might take those assets out of your estate at today's value rather than, as Steve mentioned, the appreciated value when you die. And then also trying to make some other kind of plans to put income in 2020 rather than 2021 when we are assuming it may be a higher rate. So some things to think about or whether to use your full benefit of the current $11,580,000 per person gifting in 2020. Biden has said he's not planning on doing away with the portability, which is the ability of a husband and wife to transfer, use the unused portion of the first spouse to die's unused exemption. So there's not a need to do the gift switching necessarily from husband and wife just to get assets into one of the spouse's names. And he also says he's not going to do what's referred to as the clawback, which means if you make a gift in 2020 that would have been taxable in 2021, you would not pay tax in the future years for gifts you made under our current tax laws. So the opportunity is there. If you have assets that you are not relying on for your livelihood. You're okay making a permanent gift away. You know, if you've got the friendly trustee, if you've got a situation where assets can be removed from your estate and you're above that threshold of 3.5 million, you may consider making gifts. Anyone certainly above the 11,580,000 already should be thinking of, have I used my full exemption amount? And then individuals that are in that bracket of 3.5 million to the, you know, and above may consider making gifts so that they can get that asset out of their estate and avoid, one, that asset being in their estate, but also the future appreciation. And you've got to balance that with the fact, you know, of what your family needs are and stuff. So certainly something to be considered. Other items that you should think about as we're planning in 2020, we have another month and a half left. At least several people have proposed that it's more possible that income tax rates for the corporations may go up easier than the individual tax rates. So for those people owning businesses, the corporate rate under the proposed Biden plan would go from 21% to 28%. So those individuals, those that own corporations, may want to consider putting as much income you can in 2020 rather than having that income deferred to 2021. Some specific planning items for accelerating income for a corporate owner would be maybe to turn off the bonus depreciation that's been allowed, pay bonuses in 2020 rather than 2021. Certainly, if you have a pending sale of either a corporation or stocks that you know you want to sell, selling those in 2020 under our current capital gain rate for long-term capital gains is 20%. Under Biden's plan, long-term capital gains for after $1 million would be taxed to those individuals earning more than $1 million at the ordinary income tax rate, which could be as high as 39.6%. So if you know you have certain assets you're going to sell, land you're going to sell, certainly if you have the opportunity to sell it in 2020 rather than 2021, that might make for a good plan. Biden's plan does propose the reinstatement of the higher tax bracket of 39.6% for those, and he's proposed it for anyone earning over $400,000. He's also proposed going back to the limitations of itemized deductions to for some of the charitable and phasing out some of the itemized deductions that people take on their Schedule A. So you've got to balance again your planning. If one of your items is a large charitable gift, most are suggesting go ahead and defer that to 2021 when we think income tax rates would be higher, but you'd have to balance that with the possibility that we may have a phase out of some of our itemized deductions. Again, capital gains rates would be a big planning opportunity for anyone that knows they have an asset that is going to qualify for long-term capital gain rates, and if they can sell those in 2020 as opposed to 2021. Another item under Biden's plan is a payroll tax of 6.2% that would be shared with employers and employees for any income over $400,000. So again, for individuals that have the opportunity to take income in 2020 as opposed to 2021, that's on a payroll tax. Accelerating that into 2020 would make a better plan for reduction in tax. If you've got installment sales, it might be you want to turn off the installment sale and pay the gain in 2020 as opposed again to 2021. All these are planning opportunities that might make sense for individuals that have those certain fact patterns that allow income to be accelerated in year 2020. Again, we mentioned deferring deductions, taking larger deductions in 2021 to offset that income in 2021 when we are assuming there possibly is higher tax rates. We mentioned bonus depreciation, deferring deductions, whether it's retirement contributions or other planning opportunities that you could defer into 2021. 2021 may make sense. So those are things everyone would have to weigh and decide if those fact patterns fit in. But we're assuming that, again, with our stimulus package and our economic situation, that there possibly is going to be some tax increase in 2021. We just don't know, of course, for certain, and you never do. We're always predicting what could happen, but that would be what may happen in 2021. So something to think about, and certainly if you can make adjustments in your gifting or your income that doesn't cause other pain in your life and that you can live with, it might make sense to do these items so that 2020 is more of a high tax year than 2021. Andy's going to mention a few items that may make sense now that we are looking for a lower exemption amount, possibly in the future. Andy's going to discuss a couple planning opportunities that may help individuals. Andy's a partner here at Manning Fulton. He works with clients with estate planning and administration matters and also represents clients of closely held businesses. He regularly advises clients on estate planning matters from a tax perspective to help maximize opportunities. He's a licensed CPA, and he's going to discuss several planning opportunities to reduce your estate tax exposure. Andy?
Thank you, Sandy. There's obviously a lot more than these two, but for time purposes, we're going to discuss these. These are things that have been used in the past, but when the exemption amount went up to 11.2 roughly million per person, doubled for married couples, a lot of these fell out of fashion because there were fewer taxable estates out there. So the two I'm going to discuss briefly are irrevocable life insurance trusts and using family LLCs or limited partnerships for gifts. So on the next slide, we'll start talking about irrevocable life insurance trusts, and you may commonly hear these referred to as ILITs, I-L-I-T. And what happens here, as soon as that slide comes up, there we go. So let's take the example now. Again, let's stress that we don't know that estate tax exemptions are going to be reduced to these levels, but for the sake of these examples, we'll say that Biden's plan of 3.5 million exemption comes into play. Let's assume for our example that your estate is on the left. If you can go back one, Sandy.
Okay.
So for example, you've got $1 million in real estate. Let's say you've got a house and maybe a vacation home somewhere. You've got another $1 million in cash and investments, $1.5 million in retirement plans, 401ks, IRAs, et cetera, and $1 million in life insurance. So your estate is $4.5 million. If you look over to the right, if we've got a $3.5 million exemption, when you pass away, your estate, $1 million of your estate is taxable. If the estate tax rate is indeed 45%, you're going to have to cut a check to the IRS for $450,000. And I don't know about you guys, but I don't ever want to have to write a check to the IRS for that amount. So the use of an ILIT, we'll see on the next slide, helps you remove some of that money from your estate. So if we look at our estate now with our real estate, cash, and retirement, what we're going to do is we're going to take that life insurance policy and we're going to put it in an irrevocable life insurance trust. Now, that trust is not included in your estate. So the $1 million comes out of your estate. It resides in the irrevocable life insurance trust, and it's not included in your estate. And what happens is you've now reduced $1 million from your estate. Your estate is at the exemption level. You have no estate tax liability. Now, there may be some other things with the life insurance. It depends on how we get it in there, whether there's a new policy or a gift, things like that. I know I'm going through this at a very high level, but it's a relatively simple planning technique that if you're using life insurance for estate planning purposes, can help you get under the estate tax exemption. Now, obviously, when it goes into an irrevocable life insurance trust, you lose control of it, but the policy pays out just like it would if it's in your own name. It still goes to your beneficiaries. It's tax-free, those types of things. So those may come back into fashion more if the exemption amount goes down. And like when Steve was talking about, the amount was 600,000. They were used a lot back in the 80s and 90s. The next example, oh, sorry, Sandy. The next example is using a family limited partnership or LLC. And this example here allows you to create an entity. A long time ago when these came into fashion, they used limited partnerships. Partnerships these days are used much less than LLCs, but your limited partnership, for example, can hold regular assets. They don't have to be a partnership operating company or things like that. It certainly can be, but you can put your investment accounts, your real estate, your operating company, if you have one in your family, into your limited partnership. It's much easier to transfer ownership interest in a partnership than it is a piece of real estate. You don't have to record deeds if you're moving real estate to your kids, things like that. And what you do in this example is you spread the ownership interest out among the family members that you want to participate. And I did not designate it here, but you will have a mix of general partnership interests and limited partnership interests. And if you have any questions about that, you can call us and we can go into more detail on it. But what happens there is, if anybody's worked in a company or owned it, you'll notice that nobody has control of that company. So if we go to the next slide, you'll see our diagram is still the same, but as a result of not having a controlling interest, the interests are not worth as much. If you want to go buy a company, 49% is worth a lot less than 51% is, because you can't make any decisions. And so over time, the IRS has allowed people to discount the value of those partnerships. So because those interests are not controlling, they don't have the ability to make decisions, they don't have the ability to independently pull out assets. And what we've seen historically is that these discounts on the value can range anywhere from 20 to 45%, depending on what assets are in the partnership. And we'll show you on the next slide how that can work in the estate context. So if we look over on the left at pre-discount, again, a lot of the same assets. You've got real estate, cash and investments, IRAs, 401ks, and retirement and life insurance. You've got a $4.5 million estate. Now, let's say we create this partnership and we put our real estate and our cash and investments in the partnership. Our estate's still $4.5 million, but we're just holding $2 million of it inside that limited partnership where the ownership is spread among family members. So on the next slide, pre-discount, we've got $1 million taxable estate, and if the estate tax rate is 45%, you're going to have a $450,000 estate tax. Now, use our family limited partnership discounts that the IRS can allow, and let's say in our example that we get a 25% discount. That reduces $500,000 from the value of our limited partnership. Now, the value of the assets inside the partnership don't change. Those are still $2 million, but the discount allows our total estate to come down to $4 million. If we take our tax rate times that, we get a savings of $225,000 from an estate tax perspective, but the assets themselves haven't changed. And so this is a technique. There's a lot of complexity with this one, and it works better at higher values when the savings can be more, but nonetheless, it's just a simple example to show you how they function. And of course, there's some other things that you may be familiar with: GRATs, grantor retained annuity trusts, and so forth. So these aren't obviously the only two options to get your estate tax down, but two more common ones that may come into play if these reductions in the exemption amounts do happen. So I'm going to pass it back to Steve Byrd for some closing comments at this time. Thank you.
Thank you, Andy. We don't really have time to discuss this final slide before I move to closing comments in the way that it needs to be discussed. This is one of the more complex vehicles that estate planning community has been using to transfer wealth. The idea, and it's become more and more commonplace in the financial advising community, oh, you need to go talk to your lawyer about slats, and this is how it works, by the way. Extremely complicated vehicle from a tax standpoint. It kind of brings the intersection and confluence of income tax law, estate and gift tax law all together in a complicated analysis to make this work. But simply speaking, what this looks like is one spouse, it works best for married couple planning, one spouse would transfer wealth, which typically would be ownership interests in entities like the Blair Family LLC that Andy just showed you, right? So husband could put together a number of LLC packages and transfer 48% non-voting interest in the Blair Family LLC. If you think back to Andy's diagram, that 48% non-voting interest would go into the husband's legacy trust. It would be administered at that level. The trust assets would be administered by an independent trustee who is someone unrelated and not subordinate to the husband, and as well as a family trustee, if in fact you want to add a family trustee. And the spouse who can be a beneficiary of this trust could also be a family trustee. Now, the independent trustee has the power of discretion to distribute assets to any of the beneficiaries, the wife, who of course is a member of the husband's household, the children and the grandchildren, pursuant to whatever distribution standards that you put in the trust document, subject to certain limitations on that. But the fact is, the husband can transfer wealth into his legacy trust for the benefit of the spouse. Has the household wealth necessarily moved from the family household? Well, if the trustee decides to distribute not just the income, but principal as well, the spouse household still has access to the wealth that was transferred under current estate and gift tax law. Now, if spouse passes away, then obviously households access to the wealth is cut off. But in many situations, this is a very flexible situation where one spouse can transfer into a legacy trust for the benefit of a spouse for the rest of the spouse's life and the children and the grandchildren. This could be a perpetual trust that skips estate taxes from generation to generation under current law. What about the independent trustee? Well, we draft these, as most people do, to give the husband the right to remove the independent trustee at any time. White hair, blue hair, yellow hair, red hair. I don't like you anymore. You're gone. And the trust typically gives a family member, and sometimes the wife, the right to appoint a replacement independent trustee. What is a trustee managing? Well, very typically, they're managing a non-voting interest in a Blair Family LLC. Think back to Andy's diagram. What does that LLC have? It has investments, marketable securities, cash, real estate. It can have any kind of asset. In fact, the legacy trust could have life insurance on the husband's life, and the income generated by the 48% non-voting LLC interest or the 96% non-voting LLC interest held by the trust that were gifted to the trust at a discount, that income from that ownership interest in the legacy trust accumulates in the legacy trust from the LLC, can be distributed to family beneficiaries or retained and grow as a family bank. So this is how you park appreciation. You capture appreciation outside the husband's estate at substantial discounts. As Andy mentioned, 20%, 45% discount from the value of the underlying LLC that's been transferred. Who runs the LLC? Well, typically it's husband and wife are the voting interest holders of that LLC. The trust has a non-voting interest only. Many of your trustees prefer to hold a non-voting interest. It makes them nervous to own 96% of any company of any kind because the fiduciary responsibility goes up. But if it's a non-voting interest that held by the trust, then it becomes a very attractive mechanism. Stay tuned. The Obama plan likely will pick up on the playbook, the green book from the Obama's green book that basically targeted these trusts for change, legislative change. It might not be as attractive as it looks now, but the wealth will be transferred. Your family member could still be a beneficiary of that trust. Transfer wealth at discounts, it continues to grow in value. I am sorry, y'all, for going over for 30 minutes, beyond our 30-minute time allocation. I hope that you've all gotten something out of this. It is a very uncertain time in our government environment, our potential tax legislative environment, and we won't know until the 2 Georgia runoff elections occur in January what the ultimate Senate composition would look like. So much of the Biden plan depends on having essentially a sweep in the power of the House, Senate, and the presidency, which is why this is so important for high net worth planners. If we can help you or answer further questions, you have our email contact at the end of this program. Thank you very much. The end of our slide deck. Thank you very much for joining us, and stay dry today. Stay dry from the political changes too. Take care.
Thank you.
Bye.